Good evening, everyone. Today is the third day of Direct Tax Relearn series in corporate taxations. And we have with us Chairman WIRC C. Arpit Kabra, Speaker of today's session Deepa Seth, Coordinator Kruti Parikh and Amisha. I welcome you all on this we are coming up with another exciting subject. So before moving further, I request to Chairman WRC to please say a few words to our participants.
Good evening, everyone, and it's a warm welcome to all of you. I think it has been an absolute delight. This series has been a wonderful series, and I'm sure a lot of good feedback that we've received from this series. One of the most important part that we've done is to set up conversations between our members. That if you are finding any difficulty, if you need any help, if you need any support on any of the aspects, I think we've got faculties, we've got good people who can respond to you. And I think in that series, let me also congratulate Deepa for taking out time and making herself available to talk and probably facilitate some good discussions in this wonderful series. To all the people who are texting in the chat box saying that presentations, of course these presentations will be available to you. Ritik and Asmita, don't worry, we'll be sharing this both to you. These are some of the highlights at WIRC, and I just want to take a quick route through all of this. Wednesdays, we do a lot of Women on Wednesday programs. Faculties who are women, different approaches, different practices, different possibilities that we can do for women chartered accountants is what we celebrate on Women on Wednesday. Pinky Madam and Shweta Madam both are working very hard on this, and therefore we've got a wonderful series on women chartered accountants. Thursdays is reserved for technologies. We talk about technologies. We talk about creating our own chat GPTs. We talk about creating our own AI tools. We talk about doing anything and everything which involves technology, using AI, using all other aspects as well. This time we are going to talk on this Thursday on Tech Edge series. We are going to talk on how can we use legal drafting. How can we draft documents using chat GPTs and using AI? I think one of the most sought after sessions. Please do log in and join us. Friday Fundas is another series that we've launched, and I think we've got a very good feedback on Friday Fundas. One of the important sessions on Friday Fundas is 12 most essential soft skills that we need in practice. I think you should please watch that on our YouTube channel, WRC of ICI. It's one of those series that can be used to train your staff as well. A project Saptrishi, there are 7 areas of collaboration, and you can see career counseling, faculty development, syllabus, accounting museum, reading room, blockchain, and most importantly, all of these are being planned just to ensure that we can all create some meaning out of our collaborations with academicians. Which we need accountants, we need a lot of support from accountants, and therefore that is what we do. Niryat series is another series for offshore, all the offshore entities, all the offshore work that can be garnered, that can be outsourced to India is what we talk about in Niryat series, different jurisdictions. Very soon we are coming up with Abu Dhabi. You must definitely, if you are one of those people who want to start up something in outsourcing opportunities, you can please follow us on Niryat series. Next Cafe is Gurukul at WRC, Prerna, and Startup Lab and Samvad Vishwaska. So this series is somewhat in the line of Samvad Vishwaska. Tax clinics that we do a lot of these things. Project Vasundhara is another series, again led by Shweta Madam. She's working on a series of programs that will help us work on greener balance sheets for a greener planets. And that is what we do. Everything that we do is with pride. Perform, relearn, innovate, distinguish, enrich. This is what is the theme for WIRC this year, and therefore we are following it up. All of us are celebrating 75 years of ICI, and therefore the pride in each one of us. So with these words, thank you very much for joining in, and I'm sure you will have a wonderful thing. If you need any further help, please feel free to reach out to us. All our social media networks are live. I would also urge all of you to please focus and look at our networking zone in our newsletters. They are one of the most exciting spaces of WIRC. The entire country is looking into it. Anything you want to network, any partners, any employment, any opportunity you want to take up, networking zone is the place that you should list yourself, and you will get something out of it. With these words, thank you very much. Over to you, Shweta Madam.
Thank you so much, Chairman sir. I recognize the presence of Treasurer WIRC Ketan Sayya sir also. And friends, let me tell you, this is just a 6 month. This team has took over the charge, and they have launched so many things, and we are really enjoying working under the dynamic leader, C. Arpit Kabra sir. And this team is doing great work. My congratulations to all of you. Thank you. And moving ahead, I request to Ami Shah to please introduce our speaker today. Ami, we are not able to hear you. No.
No problem, Shweta madam. I think it's all right. And Deepa, may we request, once Ami will be back, we'll do the honors and introduce you. But I think thank you very much for taking out time, and the context, the subject that you have today will have a lot of impact. So if you may please continue.
Sure.
Yeah.
Thank you.
Am I audible?
Yes.
At the outset, I would like to thank WIRC for giving me this opportunity to share my views and to share my practical experience with ICDS. So the reason for selecting ICDS as a topic is that the tax audit season is around the corner, and we would need to give impacts in the tax audits and thereafter in the return of income of the adjustments which happen in the ICDS. And therefore, we thought that ICDS could be the most relevant thing. The things which I'm going to cover here is the applicability, its comparison with the AS and or ICDS and or IND-AS, and the practical approach that we should take while adopting this ICDS. With this, yeah. So let me just take you through the background. So this is a brief introduction or the timeline with respect to the ICDS. So earlier these were notified or these were published, 12 draft ICDS were published in March 15, out of which only 10 were notified. So lease and intangible assets is still at a draft stage. In Jan 16, there was some deferment which was announced, and thereafter in July 16, it was announced that these ICDS would be applicable from AY 17 and 18 onwards. Thereafter in September, revised ICDS were notified. In March 17, CBDT came up with a few clarifications or a few FAQs to address the issues or challenges in bringing across this ICDS. And in July 17, there was a complete, ICAI had come up with a technical guidance on this entire subject, which covered each and everything right from the ICDS, thereafter the FAQs, judicial pronouncements, etc. After this, there have been, so while implementation of ICDS is still a phase, I would not say that it's completely done because still a few provisions of the Act may need to be reworded. But what has happened is that over the years, there has been a lot of amendments to align or to ideally support the ICDS in the provisions of the Act itself. So how have this ICDS being introduced? It is introduced by virtue of section 145(2), which relates to method of accounting and the accounting in relation to income. So this is how 145(2) ICDS have been introduced. There is a Delhi High Court decision which was challenging the constitutional validity of ICDS. This decision has now been put to rest. It has been disposed of, saying that if there are any landmark Supreme Court or High Court decisions, of course, they would need to be looked into while applying these ICDS for income computations. Now, even in May 2011, there was one draft ICDS on real estate. However, this also has not been notified as yet. So still we have 10 ICDS. Moving to the next, what will be impacted by these ICDS? Each and everything, if I may put up advanced tax, tax audit report, computation of income, tax return, deferred tax, provision for tax. So everything may take a toss if ICDS is applied. What are the salient features of ICDS? So let's talk about the applicability. To whom will these ICDS be applicable? It would be applicable to the taxpayers who are following mercantile system of accounting. So one is mercantile system of accounting. But when I say mercantile, not to all the taxpayers, there is a small carve out which says that individual and HUF who are not liable to tax audit may not be required to follow these ICDS. Second is PGBP or IFOS. So people who are earning income from profits and gains from business or profession or income from other sources, only to these sources of income ICDS will apply. The third thing is that it will not apply for maintenance of books of accounts. So if you see books of accounts, that still would be governed by the AS or the Ind AS or the IGAP. But however, for the purpose of computing the taxable income is where ICDS will come into play. Coming to the features, what ICDS, so there have been a lot of disputes in this domain when it comes to PGBP. So to put a rest to all of these things, the CBDT had come up with these ICDS. So what the intent is, the preamble says that they want to have a uniformity between the accounting policies governing these computation of income as well as the tax related provisions, so that there are less irregularities and therefore the litigation can be curtailed to a certain extent. If there is a deviation from the ICDS that can result into a best judgment assessment is what section 145(3) brings up. So this is just a brief background about the ICDS. When I mentioned earlier that it will apply only to mercantile system of accounting, a question may arise what happens to a hybrid system of accounting where I have two businesses, commission business where I'm following cash system and manufacturing business where I'm following mercantile system of accounting. In this case, it is very specifically mentioned in the guidance note that ICDS would apply only to the manufacturing business where mercantile system of accounting is followed and not to the commission agency business where cash system is followed. What are the other considerations at the time of ICDS? So if there is a conflict between the provisions of the Act and ICDS, what would prevail? In this case, of course, the provisions of the Act would prevail because that is what is a preamble and that is what is laid out in each and every ICDS, that if there is any conflict, what is going to be prevailing is the Act, because that is a complete code in itself. If there is a conflict between the judicial rulings and the ICDS, what prevails is if the judicial rulings are interpreting some provisions of the Act, then one would need to resort to the judicial rulings, as we also discussed in the Delhi High Court writ petition, which I mentioned, which was challenging the constitutional validity of ICDS. Now, if the judicial rulings are in relation to some commercial principles or are in relation to accounting standards, then in that case, one would need to resort to the ICDS because ICDS has a different nomenclature and the rulings may not be the correct thing to look into. Where there is a conflict between the rules and the ICDS, in this case also, like we mentioned that Act would prevail, here also the rules would prevail because rules are in accordance or in consonance with the Act. If there is a conflict between the provisions which are laid down in the circulars and the ICDS, what happens is that circulars, as you would be aware, that circulars are generally binding only on the tax authorities and not on the taxpayers. And therefore, one can always take a contention that ICDS should prevail over the circulars. What happens in case of MAT or AMT provisions, which is where we are computing book profits for the purpose of MAT provisions, minimum alternate tax. In these cases, see, for MAT or AMT, we would be starting with book profits, and book profits ideally don't require ICDS to be followed because this is not where we are computing the taxable income, and therefore ICDS would not apply to AMT or MAT provisions. Presumptive tax regime. So whether ICDS would apply to presumptive tax regime, the answer is that when it comes to presumptive tax regime, we are not required to maintain books of accounts. So therefore, one could contend that ICDS is not applicable. However, presumptive tax would be applied on a gross receipt or a turnover. For computing this amount on which the presumptive tax has to be applied, ICDS needs to be looked into, and therefore ICDS are applicable to presumptive tax regime. Whether ICDS would be applicable to non-residents, liable to tax on gross basis. Here the answer is that non-residents or residents, ICDS does not demarcate between the two. So therefore, ICDS are applicable to non-residents. But when it comes to this specific case of liable to tax on gross basis, here also, for the purpose of determining that what would be that gross income or what would be that amount on which the taxation on gross basis would happen, to determine that amount, ICDS would come into play. So these are the other considerations when it comes to ICDS and whether it would be applicable and what would supersede the other. Coming to disclosures, we've been discussing so much about income computation and disclosure. The question is, where will you disclose this? The disclosure is required to be done in Form 3CD. So what I have done is, this is the exact extract of Form 3CD where clause 13, there is sub clause D, E and F is where the disclosures and the computation is required to be mentioned. Whether there's an increase in profit, decrease in profit, what is the net effect, and if there is any disclosure separately required, that would come under clause F. So this is where the disclosure in relation to ICDS needs to be made. So this was a complete background about ICDS. What I will do is I'll take up the Q&A at the fag end so that we don't waste on time. The reason is it is bulky and we have to cover 10 ICDS within a span of 1 hour 45 minutes. Here I have given a comparative summary of what ICDS we are looking into, what is its corresponding AS and what is its corresponding Ind AS. So the 10 ICDS which we are going to discuss in the coming slides. Taking up the first ICDS, which is accounting policies. So for accounting policies, so what are accounting policies? That we will take at the later stage in time. But what are fundamental accounting assumptions? So why fundamental accounting assumptions? Because this help in preparing and presenting the financial statements in a better way. And therefore, as we've been studying, that fundamental accounting assumptions is what is required to be followed by any taxpayer. What are these fundamental accounting assumptions? Under the ICDS, they have laid out three FAAs. One is going concern, another is consistency, and accrual. What is going concern is that the entity does not have any intention to liquidate or to curtail its business operations, and it is going to go on in the near future. What is consistency? That whatever accounting policies we are following would be consistent from one period to another. And what is accrual is that whatever revenue recognition or recognition of cost is done would be on accrual basis, that is as and when they are incurred or as and when they are earned. And there will not be anything notional. Now, while laying out these three fundamental accounting assumptions, what ICDS does not have is absence of prudence and materiality concept, which you would otherwise find in the accounting standards. So what is prudence is that if there are any estimated losses or if there are any mark-to-market gains or losses, prudence in the good old days in accounting standards used to allow this as a deduction. What is materiality is that only the things which are materially impacting the financial statements that would need to be disclosed. However, both of these concepts are not there in ICDS, which means that there is no materiality. Even if there is a smallest of small difference, one would need to make the disclosures or computations for the purpose of ICDS. And when I say prudence, no estimated gain or loss is going to be allowed to you going forward when it comes to ICDS. What are accounting policies? So as the name of the ICDS suggests that this is accounting policy. Accounting policy is nothing but specific accounting principles and the methods of applying these principles. And while selecting these accounting policies, what is it that you would need to keep in mind? Is that it has to reflect or give a true and fair view of the state of affairs and income. So while I am selecting accounting policy, I need to check whether this gives me a true and fair view or no. And while doing so, for this purpose, there are two specific things which have been highlighted in the ICDS. One is substance over form. So one would need to now go into the substance of the transaction rather than what the form it is. And second is mark-to-market loss or an expected loss, which we discussed in the prudence concept, that shall not be recognized unless it is provided under any other ICDS. So these are the two things when you are seeing financial statements, if you see any expected loss, or if you see that there is some change of substance over form, is something where we would need to go back and check if there is any impact on the computation or on the disclosures in the tax audit report. When can one change this accounting policy? Accounting policy cannot be changed unless there is a reasonable cause. Though reasonable cause is not defined, but this is a concept which is evolving over a period of time, is what the CBDT FAQs mention. So this is about the accounting policies. What are the considerations for its selection? And when can we change these accounting policies? What I've done here is, after each ICDS, what we've done is we have given a comparison between ICDS and the applicable AS or Ind AS. So the first and the second point relate to prudence and materiality, which we just discussed, that ICDS does not propagate any of these concepts to recognize any expected loss or gain. However, these concepts used to form part of the accounting standards. And similarly, there would also be a materiality for accounting standard, but not for ICDS while drawing up, while computing the taxable income. Under ICDS, another deviation is that ICDS cannot be changed without reasonable causes, what we discussed. However, under the accounting standard, they have made it very categoric that you can change your accounting policy in 3 scenarios. One, if it is required by statute. Another, if it is resulting in appropriate presentation of the financial statement. And the third, if it is in compliance with any of the accounting standards. So this is where the ICDS and AS, there is a demarcation, and therefore disclosures and computations would come into play. So now coming to disclosure. If there is a change in accounting policy, and if it has a material effect in PY is a previous year, if it has a material effect in the previous year or a financial year, and that material effect is ascertainable, then definitely we should disclose the entire material effect to the extent it is ascertainable. Now, if there is a material effect in the previous year and the same is not ascertainable, then at least we should mention the fact that there is a change in accounting policy. If there is a change in accounting policy and if it has an effect in the later previous years, like in the going forward years, then at least one should disclose the fact of such change. So say, for example, there is amalgamation which is going to happen and we are aware about it. At least a disclosure can be made. If there is no material effect of the change in accounting policy, no disclosure is required. Now, disclosure, if a fundamental accounting assumption is followed, disclosures is not required. However, if the fundamental accounting assumption is not followed, then that fact has to be disclosed. So this is about the disclosures of accounting policies when it comes to the tax audit report. So we will now move to the second ICDS, which is valuation of inventories. What I have done is that at the beginning of each of the ICDS, I have just briefly covered whatever definitions to the extent they are relevant. What is the applicability and how do you go by the measurement? So inventories. Inventories are nothing but assets which are held for sale in the ordinary course of business, in the process of production for such sale, or in the form of material or supplies to be consumed in the production process or rendering of services. What is NRV? NRV is a net realizable value, which means that it is an estimated selling price in the ordinary course of business, and we will reduce if there are any estimated cost of completion or estimated cost to make that sale, That is where we say that this is not a realizable value, but a net realizable value, which is after adjustment of expenses. This ICDS will not be applicable to WIP under construction contract, because that is something which would be specifically covered under that ICDS. If there is any WIP, which is work in progress, which is dealt by any other ICDS, again, the same would not be covered here. Securities like shares, debentures, etc., since it is specifically or explicitly covered under ICDS 8, would not be covered here under ICDS 2. Livestock, agriculture, forest products, mineral oil, ores, gas, etc., if it is measured at NRV, again, not covered under this ICDS. If there are any machinery spares, and if it is fixed or specific to that fixed asset, that would be covered under ICDS 5 and therefore not covered under ICDS 2. What will be cost of inventory? The cost of inventory will be cost of purchases, cost of services, cost of conversions, and other costs. Purchases could include duties, taxes, freight, inwards, etc. However, trade discount rebate will be reduced from this inventory cost. When it comes to cost of services, labor or personnel cost or supervisory personnel or similar overheads will be covered here. What will be cost of conversion is some fixed or variable cost, variable overheads which have been incurred for converting the materials into finished goods. Then that is cost of conversion, which also will be included as a part of inventories. If there are any other costs in bringing the inventories to its present location or condition, even those will be covered under the cost of inventories. The question is then what is not covered? The exclusions is something which I have mentioned below. If there is any abnormal amount of wasted material, labor, or other production cost, if there is selling and admin cost, if there is interest and other borrowing cost. So interest and other borrowing cost will be allowed if it is in accordance with ICDS 9, which is borrowing cost, but not otherwise. And storage cost unless it is necessary for production. So these are the exclusions from the cost of inventories. And as we discussed that how are we going to measure it? Measurement will be cost or NRV, whichever is lower is where NRV we discussed earlier, cost we have discussed here. Now, what are the cost formulas or techniques for measurement? I'll just briefly touch upon because there is a detailed guidance in the technical guidance which is available. There are two ways where we can, cost formula can be used for allocation of cost, that is specific identification of cost. And if that specific identification, when will that be possible? When the goods are not interchangeable. And there is a specific or segregation of goods between specific projects. In that case, we will have to use specific identification method where we allocate cost to that specific unit. Unit-wise, we make the allocation and that is how we value the inventory. However, if this is not there, then inventories which are not covered here, we would either be required to be measured as FIFO, which is first in, first out basis, or weighted average cost formula. So inventory can be valued by either of these methods. But if your client is using a LIFO, which is last in, first out, then definitely there needs to be some adjustment in the ICDS for such a thing because ICDS does not allow last in, first out basis of inventory. What are the techniques for measurement of cost? It's a standard cost method or a retail method. Again, the method of valuation of cost, it cannot be changed unless there is a reasonable cost. Valuation of inventories. So, valuation of opening inventory. So, as on 1st April, how do you value your inventory? If it is an ongoing business, then what we do is last year ka closing will become current year ka opening. Is what again the ICDS is also on the same page. However, if it is in relation to some newly commenced business, which is commenced like say mid of the year, then we will have to take cost of inventory on the day of commencement of business. So this is a logical thing and nothing over and above the AS. But how does the valuation happen in case of dissolution? So if there is a dissolution of firm, AOP, BOI, etc., irrespective whether business is continued or not, If it is dissolution, the inventory needs to be valued at NRV, which is net realizable value. So if today we see in the financial statements of the company that it is in the phase of dissolution, the question should be asked that how have you valued your inventories then? Is it at NRV? If no, ICDS adjustment. Here what I've done is I have given a comparative summary, as we discussed earlier also, between AS, ICDS and Ind AS. So cost of services is included in ICDS as a part to be considered for valuation. However, AS and Ind AS do not have such mention. So cost of services is never included for inventory valuation. Between exclusive or inclusive method of accounting, ICDS propagates that inclusive method of accounting should be used for the purpose of valuation of inventory. Whereas AS is saying exclusive method. So the taxes, etc., which are recoverable in future needs to be excluded. Other costs like distribution cost, etc., ICDS excludes the distribution cost. Even AS specifically excludes it. Valuation of inventory at the beginning of the year is something which is discussed in ICDS. However, the same is not discussed in AS. Interest and other borrowing cost, there is a specific mention that if it is in accordance with ICDS 9, then the same can be included in the cost of inventories. However, AS2 and Ind AS2 have no mention about the borrowing cost. So if there is any borrowing cost in relation to the inventories, we would need to go back to the client at the time of the tax audit report or the computation to check if there is any borrowing cost in this regard, because you would not be able to find this in the financial statements. Valuation of inventories at the time of dissolution is a specific point in ICDS where they say that this has to be at NRV. AS does not mention the same, whereas Ind AS also aligns itself. So this disclosure about inventories is the same thing ideally from Form 3CD itself. A, B, what are the accounting policies, total carrying amount of inventories and its classification. So all of this is very same as that of 3CD. This is what is required to be disclosed. Taking up the third ICDS, which is construction contracts. To whom is this ICDS applicable? It's applicable to a contractor. For what? For determining his income from the construction contract. What is a construction contract? I have just briefly touched upon that it is for construction of assets or combination of assets that are closely interrelated or interdependent, and also includes contract for rendering of services. When can you segment? When can you segment the contracts or when can you combine the contracts? I have given those also instances that if there are separate proposals for each asset, separate negotiation, cost or revenue is separately identifiable. In all of such cases, segmenting is the best approach, that you segment each of the contracts and recognize revenue accordingly. However, if all of this is done together, where one proposal for maybe 3-4 contracts is where we will combine the contracts for the purpose of recognition of revenue. What is contract revenue? Contract revenue is initial amount of revenue agreed plus variations in contract work, claims and incentive payments. But to the extent it is probable that they will result in revenue and they are capable of being reliably measured. So this is something which is similar to AS, which is an accounting standard. However, contract revenue shall be recognized only when there is a reasonable certainty of its ultimate collection. If one feels that this is not reasonably certain that we will collect this amount, revenue recognition can be postponed. Now, once a contract revenue is already recognized as income, and if you want to subsequently write it off, then ICDS is very categoric to say that this has to be shown as an expense and you cannot adjust it with the contract revenue, which earlier in good old days, people used to do that. From the contract revenue, I reduce this amount and net contract revenue is what I show, and percentage completion applies to that net contract revenue. However, ICDS is very categoric to say that if any of the revenue reversals, you charge it to the P&L and you show it as an expense, no adjustments can be made. Here, between the ICDS and Ind AS, one major point which deviates is, and this was the only point for Ind AS, is the reason I have mentioned it here, is that Ind AS propagates fair value of consideration received or receivable vis-a-vis what ICDS says is that this is the initial amount of revenue recognized. So whatever the contract is, if there are any variations, all of that needs to be considered. But no fair valuation required, absolutely. This is about the contract revenue. Coming to what are the contract costs. So what I've done is what will be included in the contract cost? Any cost which is directly related, which is attributable or allocated to that activities involved in the contract, or other costs which are specifically charged to the customer as per the terms and conditions of the contract. Cost attributable from the date of securing to the date from the date of securing to the date of completion of contract. All of those also costs can be included in contract cost. What are the exclusions? Exclusions is the one which is not directly attributed, which comes from the second point itself, or interest on loan or other borrowed cost, which are recognized in accordance with ICDS 9. It would be not recognized in accordance with ICDS 9. Then any contract costs that relate to a future activity, that would be shown as a CWIP, which is a contract work in progress. However, it cannot be shown as a contract cost because it relates to a future activity, and again, the concept of prudence. So this is where we've discussed what is contract revenue and what is contract cost. Going to how do you go about with the recognition? Recognition will be on percentage of completion method, which will be determined, and this is also similar to AS, where these three things have been laid down, that proportion of contract cost incurred up to date, survey of work performed, completion of physical proportion of contract work. Progress payments or advances from customers are not determinative of the stage of completion. And there is also one more caveat that if it is in the early stage of completion, that is, it is less than 25% of the stage of completion, then revenue recognition can be restricted to the extent of cost incurred. What happens to the losses? This is where a major demarcation comes into play. So AS7 used to allow expected losses, and therefore one could also find these in the financial statements. However, ICDS propagates prudence concept and therefore does not propagate prudence concept, and therefore expected losses will not be allowed as deduction here unless it is permitted by any other ICDS. So therefore, this is a demarcation between the AS and ICDS. So if in the financial statements we find any expected loss, that is a red flag that this needs to be disallowed. What happens to the actual losses? If there are any actual losses, those are allowable under ICDS. However, that would depend upon the percentage of completion method and not upfront. So this is about the recognition of income and allowance of losses. Let's take an example. So there is foreseeable losses of 50,000 in year 1, other income of 40,000. So income as per ICDS will be 40,000 because foreseeable loss will not be allowed to you, as we discussed earlier, because this is expected. So your income as per ICDS becomes 40,000. What happens to book profit? Book profit will be, because foreseeable losses is allowed for accounting standard purposes, we will knock this off, and therefore there will be a 10,000 ka loss. So this is where the taxable income is. This is where the book profit is. Let's go to year 2. Now this foreseeable loss becomes an actual loss. The contract is concluded and therefore there is an actual loss of 50,000. And there is another income of 40,000. In such a scenario, actual loss will be allowed to you under ICDS. So we can knock off this 50 with 40. That becomes a loss of 10,000. Whereas when it comes to the book profit, because foreseeable loss was earlier claimed as a deduction, now again, the actual loss cannot be allowed to us. That would amount to duplication. So here the income will be 40 only because loss has already been claimed in year 1. So this is where we are. In year 1, between ICDS and AS, ICDS income So this is a taxable income. The company will pay tax on 40,000 at the normal tax rate of 25 or 30%, as the case may be. Whereas in year 2, under the normal provisions, there is a loss, and under the book profits, there is a gain. So the company will end up paying tax here. My bad. The company will end up paying tax here, which is on this 40,000. So the taxpayer will end up paying tax in 2 years on income which is actually higher than his actual income. If you see, the actual income is a net loss of 10,000. And if we even see the actual income, it is 80 minus 50, which is 30,000. However, we are paying tax here at 40 and again here at another 40,000. So we are actually ending up paying more taxes than the actual income, which is of only 30,000. So this is about the deviation between AS and the Ind AS. AS and the ICDS. Again, this we've put across a comparative summary between ICDS 3 and the accounting standard. So the definition of construction contract under the 2 is also variably different. Method of accounting. AS used to propagate 2 methods, which is percentage completion and completed contract method. However, ICDS 3 categoric do only PCM, which is percentage completion method. Recognition of expected losses. As we discussed in the earlier slide, AS 7 used to allow this. However, ICDS 3, future losses will not be allowed. When it comes to actual losses can be allowed, however, only on POCM basis, which is percentage of completion basis. And in AS, this will be allowed in the year which is incurred. With respect to incidental income, ICDS is categoric that you cannot adjust it with the contract revenue. However, it has to be taxed in accordance with the provisions of the Act. Whereas in the good old days, accounting standard, rather in even currently, accounting standard allows us to deduct these incidental income from the cost of contract. Reversal of revenue. So if there is any reversal needs to be made, the same has to be shown as expense. And it cannot be adjusted against the contract revenue, which ICDS still allows that the reversal needs to be adjusted with the contract revenue. So as and when we come across any incidental income, we come across any revenue reversals, expected loss, actual loss is where ICDS adjustments may come into play. What are the other things? Retention money. Retention money, it needs to be recognized on percentage of completion basis, whereas AS7 is silent on retention money. However, if we see the landmark judgments, what it mentions is that when there is a right to receive and when that right is established is where one needs to offer this to tax. Recognition of incentive payments and claims. So ICDS omits the requirement that contract is sufficiently advanced, the claim will be recognized. However, AS7 still has this, that if the contract is sufficiently advanced and if it is reliably measured, then it is when it is at that point in time that one would recognize this incentive payments and claims. So the demarcations between ICDS 3 and AS7. Pertinent to note here that though the ICDS provisions are this, but as we discussed earlier, if there is any landmark Supreme Court or High Court judgment, one can always resort to them if it relates to interpreting the provisions of the Act, like we discussed about right to receive. One can still resort to those judgments. And there is per se no disclosure requirements for ICDS 3. Coming to ICDS 4, which is revenue recognition. What will be covered under revenue recognition? Sale of goods, rendering of services, and use by others of the person's resources yielding interest, royalties, dividend. So it is only these 3 buckets that get covered under revenue recognition. Let's take bucket by bucket. Sale of goods. When would one recognize income? from sale of goods when there is a transfer of property or title in the goods, and this happens for a price. There are significant risks and rewards which are attached to it. And once this goods property is transferred, there is no effective control of the goods transferred. And there is a reasonable certainty of collection of revenue. Once all of these 4 points are ticked, is when revenue recognition for sale of goods is required. And this says that there has to be a reasonable certainty of collection. Revenue recognition, what happens when there are export incentives or claims for price escalations? In these cases, revenue cannot be recognized when this claim are raised. However, it needs to be recognized when there is a reasonable certainty of its ultimate collection. Otherwise, it will get postponed. So in these cases, one would need to check if it is reasonably certain that we are going to get this, then only we can recognize the revenue. Or this happens at the time of receipt of these incentives or at the time of receipt of these claims. The primary discussion here will revolve around the fact that whether there is a right to receive income, because there's a Supreme Court judgment which says that the income accrues or arises when the assessee requires a right to receive the same. When there is no right to receive such income, revenue cannot be recognized. So this is about the sale of goods, that revenue recognition will happen when all of these 4 conditions are ticked. Coming to service contracts. So revenue recognition from service contracts has to happen based on percentage of completion method, which was not there earlier. It can be done based on straight line basis if there are indeterminate number of acts over a specified period of time. Then the ICDS has given us an option to use straight line basis. However, when the duration of the contract is not more than 90 days, the third option is that one can even follow the completed contract method, that is the entire revenue should be recognized when the project is completed. So this is that last bucket. When contract is completed, the revenue recognition will happen. So these are the 3 buckets for service contracts and revenue recognition in this regard. For percentage of completion method, we would again resort to the discussions we had in ICDS 3. How should that percentage of completion be determined? There is a CBDT clarification here that this ICDS will not apply to real estate developers, because we discussed in the earlier slide that they have already come up with a draft ICDS here. Also to bought projects, which is built, operate, transfer, and to leases. Leases also is a draft ICDS already there and therefore will not be covered here. I have taken a brief example here. So if XYZ is a software provider who develops a SaaS product and he's charging 1 lakh subscription fee per year, and this customer has signed up the contract on January 16th, how would we recognize the revenue? We can either say a percentage completion or a straight line basis, because it's less than it's only a year, not that it's going to go to the next year. So therefore, either of the method we use, and proportionately over the span of time on a straight line or a percentage of completion, we will recognize revenue month by month, and the rest of the revenue will be shown as a deferred revenue. So as we can see, proportionate from Jan 16 to 30th Jan, we've showed some income here, and then balance of the income has been shown proportionately in each of the years. Thereby, Jan 24, there is an income of 4110, and the deferred revenue has become 0. Even though the cash has been collected on day 1, our revenue recognition happens as per POC or a SLM. Taking example, now going to the third basket of revenue recognition, which is interest, royalties, and dividends. In case of interest, revenue recognition has to happen as per time basis, like time proportion determined basis the amount outstanding and the rate applicable. There are 2 carve-outs here. One is interest received on compensation or enhanced compensation, although not discussed in this ICDS. However, because there are specific provisions under the Act which say that this has to be recognized on receipt basis, that would supersede the ICDS, and therefore this revenue recognition will happen on receipt basis. When it comes to interest on refund of any tax, duty or cess, again that will happen basis receipt basis. So apart from these two specific categories, the interest or other income has to be done on time basis. If there is any discount or premium on debt securities held, then that will be revenue will be recognized over the period till its maturity. So it will be again on a time basis. Coming to royalties, how will one recognize the income as per for the purpose of royalties? Here the revenue recognition will be in accordance with the provisions of the Act and in accordance with the terms of the relevant agreement. With respect to dividend, again, it will be in accordance with the provisions of Section 222 or Section 8 of the Act. And this will not cover dividend from mutual funds. We discussed the income liable to tax on gross basis, whether ICDS would be applicable or not in the earlier slides. So that still remains that yes, ICDS will be applicable, and there is a CVDT clarification here. With respect to reasonable certainty of ultimate collection, that is not laid down for ICDS for these types of income, which is interest, royalty, and dividend. However, there have been various judicial pronouncements, and it is of paramount importance that one would resort to those judgments before making a decision here, that whether this right to receive has been established or not. However, the CPDT clarifications say that even if where there is no reasonable certainty of collection, still these revenues need to be recognized. And as and when we feel that, okay, this is not receivable, the same can be charged to the P&L. So ICDS propagates that this has to be recognized irrespective of the ultimate collection is to be done, reasonable certainty is there or not there. So this is about interest, which is time basis, royalties, which is as per the terms of the agreement and the Act, and dividend, again, in accordance with the provisions of the Act. Again, a comparative summary here. So the method for recognition of revenue from service contracts, ICDS 4 has 3 methods: percentage of completion, straight line, and completed service method. AS has 2 methods, AS 9, which is completed service and percentage of completion method. However, Ind AS 18 has only 1 method, which is percentage of completion method. With respect to recognition of interest or refund of any tax, ICDS has a specific carve-out that this has to happen as per receipt basis. However, AS 9 and Ind AS 18, they still go by accrual basis. So if there is any in the financial statements, if we see any of the items on accrual basis, then one would need to just make appropriate adjustments here, and we would need to bring it to tax only on receipt basis, and this needs to be reduced for the purpose of computation of income. With respect to discount or premium on debt securities, both ICDS and AS are of the view that this has to happen over accrued over a period of maturity. However, in AS, as everybody would be aware that it propagates discounting and fair valuation. Again, this this requires recognition of interest as per effective interest method. And therefore, there could be a deviation between the financial statements, the interest which is recorded here vis-a-vis the interest which is required to be recorded for ICDS. And therefore, some ICDS adjustments may come into play to this tune. That notional would be disallowed or would be reduced rather, because this is an income, and the actual interest income which is received will be offered to tax, received or accrued. Discounting. ICDS as well as AS both do not recognize any discounting of consideration. However, in AS 18, it requires fair valuation of the consideration to be done by discounting all of the future receipts using an imputed rate of interest. So whatever the notional accounting is done here, we would have to reverse the implications when it comes to ICDS. This is again a similar thing to whatever the disclosures are for the purpose of 3CD. So this is a disclosure which is to be required in the tax audit report as to whether all of these points are fulfilled or not. What is the amount of revenue from service transactions, from sale of goods, what is the stage of completion, etc., etc. So this is a disclosure slide. The next is ICDS 5, which is for tangible fixed assets. What is tangible fixed asset? Tangible fixed asset is an asset like building, land, furniture or fixture, plant, machinery, which is held with an intention of being used for the purpose of producing or providing goods or services. And there is no, and it's not held for sale in the course of business. So this is what a tangible fixed asset is. Of course, since the name says it's tangible, it will not deal with intangible assets. And what are we discussing in this ICDS is that how much capitalization would be allowed for the purposes of tax books. So today, if I have purchased a fixed asset, what all costs can I add it to the cost of its fixed assets, or how much capitalization can be done for the purposes of ICDS 5 is what the discussion is. So if there are machinery spares, so as and when they are consumed will be charged to revenue. But if they are in connection with a tangible fixed asset and the use is irregular or not a regular one, then one would need to capitalize these machinery spares to the fixed asset. If there are any standby or servicing equipments, that also need to be capitalized to the fixed assets. What is actual cost? What all can you include in the cost of a fixed asset? Purchase price that you pay, duties, taxes, directly relatable or attributable expenses, price adjustments, forex fluctuations, any expenditure till the production has begun. Further, there is also a CBDT clarification to say that if there are some test runs till that and before the so the expense that you incur from the test runs to the commercial production can also be capitalized under the fixed asset. If there are any improvement or repairs, if they are going to help increase the future benefits of assets, even that can be capitalized. If there are any specifically attributable to construction of the project, and if it helps in bringing it to its working condition, then even those costs can be capitalized. So these are the inclusions which can be added to the cost of the fixed asset. What cannot be added is trade discount or rebates. वो हम लोग actual cost में से reduce करेंगे. Or for that matter, admin or general overheads, not in relation to this fixed asset, to be reduced, not to be included or not to be capitalized. Any subsidy or grant, in that case, we will have to see section 43(1), which will override the provisions of ICDS, which says that one would need to adjust the value of that grant or subsidy which is receivable at the time of computing the actual cost. This is about a acquired fixed asset. What happens if I have internally developed or self-constructed some tangible fixed asset? Say, for example, for some furniture or some other things which I have internally developed it. Same principles of what we've used at the time of acquisition will apply to a self-constructed tangible asset as well. However, if there are any internal profits that will need to be eliminated. What are the other considerations at the time of fixed assets? So when a tangible fixed asset is acquired in exchange for another asset or in exchange for shares or securities, then what will you take as the actual cost of that fixed asset? What will you capitalize? The answer here is that the fair value of the asset which I have acquired is something which I will capitalize, and not the asset which I have foregone, because this is an exchange, it's a barter. So in this cases, the new asset which I get is what I will show as the actual cost. Now there is valuation also. There are two specific scenarios where a person is owning tangible assets jointly with others, Then what will be the actual asset? It is a proportion in that actual asset, accumulated debris and WDV that needs to be grouped together with similar fully owned tangible fixed assets. Another scenario is where several assets are purchased for a consolidated price. The consideration shall be apportioned on fair value basis to each of those assets. So now there are two things which are categoric, that depreciation on tangible fixed assets will not be governed by this ICDS and it has to be in accordance with the Act. And second, if there is any income from transfer of this tangible fixed asset, again, it has to be in accordance with the Act and ICDS will not cover that. So depre and income from transfer of fixed assets outside the purview of ICDS, you go as per the Act. This is what is tangible fixed asset all about. Here I have briefly touched upon the scenarios. Biological assets, there is a specific carve out in under AS and Ind AS that they will not deal with it. However, ICDS has kept mum about these things. With respect to spares, as we discussed, that if it is in relation to a fixed asset and if its use is irregular, ICDS 5 asks us to capitalize it. However, the Ind AS and AS, under Ind AS and AS, the criteria is different. It is only when it is probable that the future economic benefits associated with this item will flow and that cost can be reliably measured. It is only at that point in time that capitalization can be done. Revaluation. ICDS 5 does not require any revaluation of tangible fixed asset. However, AS and Ind AS both requires for revaluation. Retirement of assets. Again, ICDS 5 does not provide for any retirement. However, the accounting standards do provide for a retirement of assets from active use. And if it is held for disposal, then the valuation is different. It's lower of the carrying amount or NRV. ICDS 5, as we discussed, does not speak anything about the methods of depreciation because that they are saying that you go as per the Act. However, AS and Ind AS both provides various methods of depreciation under its domain. Valuation in case of exchange of assets. Here I have categorically mentioned only Ind AS. So if there is any barter where one fixed asset, barter in the sense non-monetary consideration, where I am giving up a fixed asset and I am acquiring another. In that case, we discussed in the earlier slide that fair value of the asset which I acquire will be the actual cost. However, Ind AS says that it has to be fair value of the asset given up or the asset acquired, whichever is more clearly evident. Now, we discussed in the earlier slide that if there is expense between the trial run and the commercial production, it shall be treated as capital expenditure and capitalization can be allowed here. However, Ind AS does not allow this. Ind AS says that the capitalization ceases when it reaches that desired location or condition. And it does not wait till the time commercial production begins. So this is where there could be a deviation and we would need to check with the client whether the period between the trial run and production, what has happened to the capitalization. Otherwise, we would have to take it as capitalization for tax purposes. Again, the disclosures I have kept is very similar to the one which are shown in the ICDS. All of these needs to be disclosed: description, rate of depreciation, actual cost, addition deductions. And addition deductions as again 4 limbs, depre, WDV. So this is all about ICDS 5. Going to the next ICDS, which is changes in foreign exchange rates. So any forex fluctuations will get covered by ICDS 6, which is forex changes in forex rates. 3 types of transactions get covered here. One is treatment of foreign currency transactions, translating the financial statements of foreign operations, and treatment of forward exchange contracts. So let's take one by one. The first limb, which is treatment of foreign currency transactions. Any and every, so what is a foreign currency transaction is today, if any transaction is denominated in foreign currency, I would have to report it in my currency, which is INR. How do you do this conversions? And what impact will you give it into the PNL is what we are going to discuss right now. So what I have done is, as a base, I have just mentioned here what is the definition of a foreign currency transaction. What is a forward exchange contract, which is ideally a forward contract. And what is a foreign operation? So foreign operation will cover only a branch, but subsidiaries, associates, etc. being separate taxable entities, they will not be covered here. And foreign operation has to be limited to branch or a likewise thing. So let's take up the first bucket, which is foreign currency transactions. There is a principle in relation to initial recognition. This ICDS also discusses how do you convert it at the end of the year. And then we discuss about the recognition of exchange gain or losses. So initial recognition needs to be at the date of transaction. So we will apply the exchange rate at the date of transaction, and that is how we record it in our books of accounts. There is an option to record it at the average rate if the actual rate is approximately the average rate itself. However, if the foreign exchange fluctuations differ significantly, then it is advisable to use the actual rate itself. Recognition, after initial recognition, I would want to take conversion at last day of the previous year. How do you convert? And for this conversion, what one needs to understand is what is monetary item, what is non-monetary item. This is the base of ICDS 6. Monetary items are money held, assets to be received or liabilities to be paid in fixed or determinable amount of money. Cash, receivables, and payables are the examples. Whereas non-monetary items would be assets or liabilities which are other than monetary. And this will include fixed assets, which is PPE, inventories, investments. These are all non-monetary. So what I have done is, just from the guidance note, what I've done is I have just picked up what are the types of assets which would be monetary, which would be non-monetary, whereas what are the types of equity and liabilities which would be monetary and non-monetary. Now coming to conversion. So conversion, if at the last day needs to be done of the monetary item, that has to happen at a closing rate. If the foreign currency rate is unrealistic, then NRV is also allowed. I will take an example at the end so that we are aligned with this concept. And the same principle are also there in AS and NDS, so there is no impact here. When it comes to a non-monetary item, if it is originally at a historical cost, then conversion at the last day will happen at the exchange rate at date of transaction. So again, no impact. However, if the non-monetary item is carried at fair value, what the accounting standard says that exchange rate when the fair value is determined is the rate which will be taken for financial statements. However, ICDS still propagates that exchange rate at the date of transaction needs to be taken, and therefore there will be a difference and ICDS impact which needs to be given here. In scenarios where non-monetary items, that is inventories, which is carried at cost or NRV, whichever is lower, and so say for example in this case it is carried at NRV. Here both the things say that exchange rate when NRV is determined is the thing which needs to be taken up. So no impact here again. So impact will come where the non-monetary items are carried at fair value. So we've discussed about the initial recognition and we've discussed about the conversion. So what happens to if there is any gain or loss on exchange differences? So if there is any gain or loss at the time of settlement or conversion at the last day of the previous year in case of monetary items, that has to be shown as income or expense in the financial statements. So you can claim the loss as a allowance and one can claim the gain as an income. However, if it is in relation to the non-monetary item, this recognition will not be allowed. So, which means that if there is any loss in case of non-monetary items, that needs to be disallowed. If there is any gain, that needs to be reduced. Because monetary items is what ICDS will allow. Non-monetary items, no taking such things as income or expense. In the accounting standards, it earlier used to be realized and unrealized concept, but however, that is not relevant now. One needs to examine whether it's a monetary item or a non-monetary item, and accordingly, this ICDS would be governed. I have taken one example here. So say there is a trade receivable, and as we can see, trade receivable is nothing but a monetary item. So I have mentioned that this is a monetary item. Exchange rate on the date of transaction is 75. What will be the conversion on last day of previous year? What would be that rate? In case of a monetary item, as we had seen here, conversion at the last day of the previous year. In case of a monetary item, it has to be the closing rate, except if it is unrealistic, then NRV. So in this case, exchange rate is on the date of transaction is 75. Closing rate, because it's an unrealistic currency restriction, therefore we will take a NRV. So conversion rate becomes 42. And difference of 75 and 42 will be 33, which will be allowed to be recognized in the P&L, and it can be claimed as an expense because it's a monetary item. Trade receivable, why? Again, trade receivable being a monetary item, exchange rate on the date of transaction is 68. Closing rate is 70. And as we had seen that the conversion needs to happen at the closing rate only, unless it's unrealistic, then we take a NRV. So in this case, the conversion will happen at the last day of the previous year at 70, which is the closing rate. So this two gain will be recognized in the P&L. And this needs to be offered to tax. Now, investment in shares. This is a non-monetary item. Even inventory is a non-monetary item. So taking investment in shares, exchange rate is 64. Closing rate is 66. However, conversion will happen at the exchange rate on the date of transaction only, which is 64. So therefore, there will be no profit or loss in the, and considering this is a non-monetary item, nothing will be allowed as a expense or as an income in the P&L. Taking another thing which is non-monetary, inventory. Exchange rate on the date of transaction is 62. We will take closing rate as cost or NRV, whichever is lower. So this is 59.5. Between these two, whichever is lower, again the conversion will happen at 59.5. However, no recognition in the P&L because these are non-monetary items. So this is all with an illustration that we've covered all of these scenarios. Predominantly monetary item, unrealistic, and what happens when it is a NRV. What will be the conversion rate? It is exchange rate when the NRV is determined. So this was about the foreign currency transactions. We will take the next limb of this thing, which is forward exchange contracts. Forward or exchange contracts, there are two types here. One, which is intended for trading and speculation to hedge the foreign currency risk of a firm commitment or highly probable forecast transaction. In this peculiar scenario, what the ICDS says is that premium, discount, exchange difference, mark to market, everything will be recognized at the time of settlement. However, if it is not fitting in in this category and it's a normal forward exchange contract, the guidance says that premium or discount one has to amortize over the life of the contract as an expense or an income. And if there is any exchange difference, that is mark to market gain or loss, or if there is any profit or loss on cancellation or renewal, then that can be claimed as an income and expense for the previous year. So very clear that premium or discount we will amortize. However, exchange difference or any profit on cancellation, we will have to show it as an income or an expense. And when it is for the specific scenarios, then nothing doing, you recognize everything at the time of settlement. Here, in this scenario, AS differs. AS says that this also has to be done on a mark-to-market basis. Even if it is a trading, speculation, etc., it has to be recognized on a mark-to-market basis. So if this is a transaction, then there will be a difference between the AS and the ICDS, and therefore the ICDS impact would come into play. I have given one example for ease of reference. So this is a forward exchange contract. Let's take that it is not fitting in the second category, which is trading, speculation, etc. And this forward exchange contract is an obligation to pay a vendor in foreign currency after 2 months. So foreign currency rate at the inception is 65. Forward rate for 2 months is 65.6. So if forward rate here is 65.6, which means that 0.6 is nothing but a premium. This premium I will have to amortize over the term, over the period of the contract, which is a period of 2 months. What happens to, so this forward rate is 65.6, however, the prevailing exchange rate is 66.5. So the difference between 65.6 and 66.5 is nothing but the exchange difference. This exchange gain will be recognized as income for the said period. So what I have done is I have given effect to premium, which is nothing but amortization. I have also given effect to exchange difference, that is exchange gain in the instant case, because after 2 months, the like today, as on day, the rate is 66.5, which is way higher. And I have secured my contract for 65.6, which means that there is a gain of 0.9. So that will be recognized as income. So this is what the example for forward exchange contracts. Now I have, after explaining this, I have just given a broad summary about the forward exchange contracts and about the foreign currency transactions. And there is one more limb to it, which was translation. So translation I have covered in this only to rather than giving it separately. So how will this translation happen? First thing is translation will be only in relation to overseas branch, and subsidiary associate being separate associates are excluded from this ICDS. However, it is included for AS 11 and Ind AS 21. What happens when I am translating the foreign operations or financial statement of any foreign operations? Whatever the exchange difference will be, that will be recognized to the P&L in that previous year. Be it exchange difference arising on translation of assets and liabilities, be it monetary, non-monetary, everything will go to the profit and loss account. However, accounting standard, if we are doing this translation, that entire differences will go to foreign currency translation reserve till that investment in foreign operation is disposed of. So there will be a separate account in which all of these exchange differences would lie. So there will be a difference here. And the third thing is Ind AS. Ind AS, if there are separate financial statements, it is in line with ICDS, that is, you recognize in P&L. If it is a consolidated financial statements, it would be shown in other comprehensive income. Now, exchange differences in case of loan, that is, loan is a monetary item. We had seen in the earlier slide. And this loan is taken for acquisition of depreciable asset. Depreciable asset is a non-monetary item. So where we have taken a loan for the purpose of acquisition of a depreciable asset, what happens is ICDS, it will say that because it's a monetary item, you recognize as income or expense, except where it is covered under 43A, then provisions of 43A will supersede if it is in relation to an imported asset. If AS 11, so irrevocable option to capitalize or decapitalize. So you don't get a chance to charge it to the P&L, but you will have to either capitalize or decapitalize. And Ind AS 21 says that it can be recognized as income or expense. However, at the time of first time adoption, there was an option which was given to the taxpayers. So this is about a comparison between ICDS, AS and Ind AS. So foreign exchange for foreign exchange contracts, what we discussed is one is foreign currency transactions, second is forward exchange contracts, and third is translating the financial statements. No disclosures required when it comes to ICDS 6. ICDS 7, which is government grants. What is covered? Subsidies, cash incentives, duty drawbacks, waivers, concessions, reimbursements. What is not covered? Exhaustive list, that if it is in relation to a depreciable asset, there is some sales tax deferral scheme, LPG subsidy, government assistance, government participation in ownership of enterprise, etc., etc. So all of these, it will not apply. What is a government grant? It is assistance by government in cash or kind to a person for past or future compliance with certain conditions. So if you meet certain conditions, you get a grant, or else no. Government I have defined. Now, when will you recognize government grant? When there is a reasonable assurance that the person shall comply with the conditions and the grant shall be received. So at this point in time is where I will recognize revenue in relation to government grant. And this recognition cannot be postponed beyond the date of actual receipt. So if you want to even postpone it, the latest you can postpone is actual receipt. Once you receive it, you have to bring it to tax. These are the scenarios which I have covered. So what I've done is that if this government grant is in relation to depreciable fixed asset, then what do we do? Section 43(1), they will say that you adjust it with the actual cost or block of the assets. So government grant, I will reduce from the fixed asset. If it is in relation to a non-depreciable asset or asset subject to fulfillment of condition, then we will show it as a deferred revenue over the period of the over the same period over which the cost of meeting such obligations is charged to income. So this will be a deferred revenue income. If a government grant is given as compensation for expenses or losses incurred, or for giving immediate financial support with no future cost, in that case, we will recognize it directly to the P&L and we will directly recognize it as income in the year in which it is receivable. If there is any non-monetary asset, so government grant is given so that you buy a non-monetary asset at concessional rate, we will record that asset at acquisition cost. If there are other grants, we will recognize it as income over the period. So this is how we will treat. So major bifurcation is between the depreciable fixed assets and others. Now, if the grants are not directly related to a specific asset, so there are say 3-4 assets for which a government grant is given. How do you allocate value to the asset is proportionate basis. We will take value of the asset acquired upon total value of all the assets for which the government grant was received multiplied by government grant. So then we can apportion that this is for A, B, C, D. Where there is a refund of government grant. So earlier it was granted to you and now you are asked to refund it back because you could not meet a certain conditions. In that case, what will happen is earlier we had reduced it from the cost of fixed asset if it were a depreciable asset. So therefore now we will increase the block by that amount if it is to be refunded, because I never claimed depreciation considering that this was a benefit. Now where I have to give the benefit back, I should be allowed to at least claim depre on this fixed asset. And now depre has to be calculated prospectively on that revised value of the block. If I need to refund the government grant in relation to some other non-depreciable fixed asset or assets, then as we discussed in the earlier slide, we have to recognize government grant as revenue over the period of the contract or over the period where I'm actually spending or incurring cost to meet that obligation. So then first I will have to adjust it against that unamortized deferred credit which is remaining. And once that is exhausted, the balance which is to be refunded has to be charged to P&L. This is in relation to refunds. I have given a comparative summary here. Ind AS includes government assistance, whereas these two do not. Recognition of grant. There is a capital approach which is there where grant is treated as a part of shareholders' funds. ICDS does not allow that. AS allows both the things, whereas even Ind AS says that it cannot be, you cannot use a capital approach. Postponement of recognition of government grants cannot be beyond the date of actual receipt. And here there is no postponement allowed only. It has to be based on if certain conditions are met, you recognize it as a government grant when it comes to AS or Ind AS. And Ind AS, a peculiar thing is that it will happen at a fair value, whereas here it will happen at the actual cost of government grant. So those notional things will have to be appropriately adjusted. If there are any non-monetary government grants, then that will be accounted at a nominal value is what the ICDS says. Even AS says the same. However, in AS, as we are aware, it would use a fair valuation or discounting, etc. These are the specific disclosures when it comes to government grants. So we've covered 7 ICDS. Moving to the 8th ICDS, which is securities. Securities ICDS is clearly bifurcated into Part A and Part B. Part A, it deals with securities which are held as stock in trade, and Part D deals with securities which are held by scheduled banks, notified PFIs, etc. We will take Part A for our discussion for these purposes, and securities is not defined for the purpose of this ICDS, but we will have to go to the definition which is provided under SCRA. And this ICDS says that we will take the same definition of SCRA, which is Securities Contract Regulation Act. However, derivatives will not be covered for the purposes of this ICDS. And this ICDS also does not deal with recognition of interest and dividend on securities, which is dealt with by ICDS 4, which is revenue recognition. It does not deal with the business of insurance, and it does not deal with Part A does not deal with mutual funds, venture capital funds, scheduled banks, etc., which is covered by Part B. So this is about the applicability of Part A and Part B. So let's take securities held at stock in trade, which is Part A. How would one recognize this? There is a concept for initial recognition. We will recognize these at actual cost, which will include purchase price, brokerage fee, etc., etc., etc. And STT cannot be claimed as a part of securities. If the securities are bartered, as in exchange of another security or asset, I am acquiring some security, as we discussed in the earlier slide, fair value of the security which I am acquiring will be treated as the actual cost. If there is any unpaid interest which has accrued for an interest-bearing security, then and upon subsequent receipt of that interest, what will happen is we will divide it into pre-acquisition interest, post-acquisition interest, and therefore the same can be deducted from the actual cost. However, this would depend upon whether the assessee is under PGBP, etc. Because capital gains, ICDS are not governed. So this, as we are discussing securities held as stock in trade, should be profits and gains from business or profession. Subsequent recognition, like we discussed in the earlier slides at the time of foreign exchange, even here there is a subsequent recognition which is required at the year end. So at the end of each previous year, securities will be valued. How do you recognize it? At actual cost or NRV, whichever is lower, which is again similar to the one which we had used principle in inventories. However, a peculiar thing here is that when we are doing this math of actual cost or NRV, this has to be seen category wise. And this ICDS provides 4 categories: shares, debt securities, convertible securities, other securities. And it cannot be done asset wise like we do. So shares of say L&T, I can't do it as cost or NRV, whichever is lower. I will have to club all the shares together and do cost or NRV, whichever is lower. Now, again, this also provides for valuation at the beginning of the previous year, as we discussed in the earlier ICDS. Generally, what is the opening cost of securities? जो last year का closing है वही ये year का opening रहेगा. Same principle for this ICDS. And if it is a new business, the day of commencement of business, जो भी उसका cost रहेगा, that will be the cost, or that will be the valuation on the beginning of the previous year. Unlisted securities or listed. but not regularly quoted, it has to be valued at actual cost initially recognized. And where actual cost cannot be ascertained by specific identification, we use a FIFO or a weighted average, which was also there in the earlier ICPS. So more or less things remain same, but one thing for securities which to be kept in mind is category wise and not asset wise. So let me take you through one example. So there is shares of say Hindalco, L&T, etc., etc. So there are 4 categories of shares. The way we value them is cost or NRV, whichever is lower. So the value would have been 75. Here it is 120, again 120, 190. The total here is 505, whereas NRV is 535. What the ICDS says is that you have to take either 560 or 535, whichever is lower, and you cannot take 505 because that is asset wise. So we will take either cost or NRV, whichever is lower. Here it is 535, and with respect to debt security, it is 600. Between 600 and 615. I cannot take individual cost or NRV. So this is something which is categoric in ICDS 8. A brief demarcation between ICDS and AS is that this covers securities. However, this covers securities. Also, properties is covered here. Classification done under categories. There are different categories here, whereas ICDS has only 4 categories. So 3 main categories and the 4th one is residual. Stock in trade is covered under ICDS 8, whereas for the purposes of AS, it is outside the scope. Valuation has to be cost or NRV, whichever is lower. However, for AS, long-term investments at cost, current investments, same cost or NRV. So they bifurcate it into long-term and current investments. Unlisted shares are covered here, whereas valuation for unlisted is not covered under AS 13. One thing which I forgot was when it comes to part B. So here I had ended part A. Coming to part B is very simple. Securities held by scheduled banks or notified PFIs. Measurement, recognition, and classification has to be as per RBI guidelines. So ICDS will only allow the ones which are in accordance with RBI. If it is not in accordance with RBI, it would not be allowed for ICDS purposes. So there is no further discussion here, like we discussed initial recognition, subsequent recognition. All of that is not required. Only RBI guidelines is what is required to be seen. This is about ICDS 8, which is securities. Coming to the next ICDS, which is ICDS 9, borrowing cost. Borrowing cost interest is defined under Section 2 of the Income Tax Act. So that's an inclusive definition. Plus, and borrowing cost has an inclusive definition. It includes interest and it includes other costs. What are those other costs? Commitment charges, amortized amount of discounts or premiums, amortized amount of ancillary costs incurred in connection with arrangement of borrowing, finance charges under finance lease or similar arrangements. So all of these costs, other costs will also be included as a part of borrowing cost. And CBDT FAQ 21 says that if there are any bill discounting or other charges, the same also will be included as a borrowing cost. What will be excluded is actual or imputed cost of owner's equity or preference share capital. So for the purpose of ICDS 9, there are 2 definitions which are very important. Like we saw for ICDS 6, where I said that monetary and non-monetary is something which you will have to see for foreign exchange. For ICDS 9, what needs to be kept in mind is what is borrowing cost, what is qualifying asset. Borrowing cost, we've seen the definition. Qualifying asset, it includes tangible, it includes intangible asset, and it includes inventories which take 12 months or more to bring it to its saleable condition. This 12 months is not attached to tangible or intangible. It will anyways be covered under qualifying asset. When will it be recognized? Borrowing cost. So borrowing cost, which is directly attributable to a qualifying asset, that will be capitalized to the cost of that asset. Other borrowing cost we will recognize as per the Income Tax Act. If there is any borrowing cost which is in relation to inventory, And if it is in specifically for this, then we will add it to the cost of inventory. Eligible borrowing costs for capitalization. So there is any specific borrowing, then as we mentioned that the actual amount of that borrowing cost will be capitalized. If there is any general borrowing, there is a formula which is given, which also we will discuss in the coming slides. And there is a CBDT clarification that this has to be done asset by asset and not category wise, which we discussed for ICDS 8 securities. When will the commencement of capitalization begin? So if there is a specific borrowing, it will begin from the date of borrowing of funds. Because this borrowing I have taken only for buying that qualifying asset, and therefore my capitalization starts the day I sign that loan agreement from that day itself. If it is a general borrowing, the capitalization will start when those funds are actually utilized for buying that qualifying asset. So this is when the commencement starts. When do I have to stop the capitalization is when the asset is first put to use, be it a tangible or an intangible asset. The moment it is first put to use, your capitalization ceases. In case of an inventory where substantially all activities necessary for its intended sale are complete is where you stop the or cessation is of capitalization happens. Where a qualifying asset is completed in parts and that completed part is capable of being used independently, then the qualifying asset would be, that part would be a qualifying asset, and the capitalization of commencement and cessation would apply to it separately. So this is where we've discussed about commencement of capitalization, cessation of capitalization. There are three FAQs here. Bill discounting, which we covered earlier, that will be a part of borrowing cost. Here, this has to be done asset by asset basis. So I have given an example at the next slide, which will help us relate to this. And what happens if there are specific disallowances under section 14A, under section 40A IA, 40A I, or for that matter, 40A 2B. So if there are these specific disallowances for the purpose of capitalization of borrowing cost, we will only see those borrowing costs which are actually allowable under the allowable as deduction under the Act. And we will exclude all of these disallowances because they are in any ways disallowed, so we cannot capitalize it then. That is what the FAQ says. That example which I have taken here is, this is in relation to specific borrowings. So I took a loan for acquiring some capital, for incurring some capital expenditure. 1st April 15 is where I had taken a loan of 10 lakhs. And January 16 is where actually I bought that capital asset. The interest rate is 12%. So borrowing cost for the year becomes 1,20,000. Date of first put to use is 1st April 16. So how will I go about with the capitalization? Period of capitalization, when will I start the commencement? Because this is a specific borrowing for the purpose of ICDS, the date when I borrow the funds is where the meter starts, which is 1st April 15. When will I have to stop the capitalization is 1st April 16, when I actually put the asset to use, because it's a qualifying asset. So for the purpose of ICDS, it will be 1st April 15 to 1st April 16, which is entire 12 months, and therefore full 1,20,000 has to be capitalized. However, when you go to your books of accounts, what the auditor would have done is that he would have capitalized it only for 3 months. From the date the capital expenditure was incurred to the date of put to use. And therefore, there will be a demarcation between the two is where we will have to give ICDS impact. And your borrowing cost or your tax capitalization. So the depre schedule under the tax will not match with the depre schedule under the books of accounts, because this capitalization will vary. This is an example about specific borrowing. General borrowing, which I discussed about the asset by asset basis. So general borrowing, we have a formula of A into B upon C. So how will you arrive at that thing? So what is A is the borrowing cost incurred during the previous year, excluding the specific borrowing. So this is general borrowing cost. These are the qualifying assets and these are the total assets. So what we do is general borrowing cost multiplied by the qualifying asset upon the total asset. And how do we have to do this is we have to do this asset by asset. So say for example, general borrowing cost is 10 lakhs multiplied by 150. This is average. So all of these have to be average. Average of the building is 150. Average of the machinery is 25. Average of the furniture is 70 and 130, which is 100. And average of these assets is 1500. So each of these things I will apply 10 lakh into 150 upon 1500 is where I will arrive at the borrowing cost to be capitalized for building, for machinery, for furniture, asset by asset basis. So this is about the general borrowings. I've given a comparative chart about what is a qualifying asset. So as we discussed in the first slide about borrowing cost, that this 12 months condition is only for inventories, whereas for AS, they require that any asset needs to ordinarily take, if it is taking substantial time, will be a qualifying asset. Criteria for capitalization, they have defined such certain criteria when it is probable that they will result in economic benefit and cost can be reliably measured. No such criteria under ICDS. As we discussed in that example, specific borrowing, the capitalization starts from the date of borrowing, whereas in case of general, it starts from utilization of funds. However, AS has its completely different norms for commencement of capitalization. When it comes to amount to be capitalized, here we are saying actual borrowing cost has to be capitalized, whereas the accounting standards allow you to reduce the income on temporary investments. If there is any temporary investment which you've made, that can be adjusted against the borrowing cost, which ICDS does not allow. And for general borrowing, we have this formula. However, AS has a capitalization rate, which is a weighted average capitalization rate. Here what I've done is a comparative summary between even Ind AS 23. So suspension, if there is extended period in which active development is interrupted, there is a suspension. However, ICDS has no provision for suspension, that interim you can suspend the capitalization. When it comes to cessation, what we discuss is in case of qualifying asset, rather in case of tangible and intangible asset, where the asset is first put to use, and if it is inventory, then where substantially all the activities are completed for its intended sale is where we stop the capitalization. However, AS has its different thing, which is common for inventory, is what they use for everything. So tangible and intangible fixed assets, there would be a demarcation here. Interest on loan, how would you account it? We will take the actual borrowing cost. Similarly, even AS takes the same thing. However, Ind AS will use the effective interest rate method, and therefore borrowing cost for their computation will be completely different. So therefore, whatever the capitalization happens under the tax books and under the accounting or under the regular profit and under the regular balance sheet will not tie up, because there would be these many differences. The last ICDS, which is provisions, contingent assets, and contingent liabilities. Applicability, here it is applicable to these three. However, it's not applicable to financial instruments, executory contracts, depreciation. More importantly, this does not apply to RDD, which is doubtful debts, depreciation, impairment of assets, anything which is covered by any other ICDS. Provision for employee benefit. Also, there is a CBDT clarification that this will not be covered by ICDS 10. What is the definition of provision and how do you recognize it? This is something which is similar to accounting standard. However, one needs to note that no provision when the cost to be incurred to operate in future. So if it is in relation to some cost which has to be incurred in future, no provision will be allowed. Prudence, because there is no prudence here. Contingent liability, again, the definition remains similar to what we have it for AS. However, contingent liability shall not be recognized. So provision shall be recognized only when there is a technical estimate or when it is backed up with some engineer's certificate, etc. So there has to be some past event and a reliable estimate can be made. It is only at that point in time that you can recognize provision. However, in case of contingent liability, the same cannot be recognized. Again, with respect to contingent asset, the same cannot be recognized. So provisions, when you have sufficient backing, can be recognized as an expense, but contingent asset, contingent liability definitely cannot be. Provisions, when best estimate of the expense required to settle present obligation at the end of the previous year, and no discounting to present value is to be done here because Ind AS requires the discounting to present value. So this is how we measure a provision. And this we will review at the end of each financial year. If it is reasonably certain that outflow of resources will not be required, then we may reverse it. So reviewing it at end of each financial year would be required. With respect to contingent asset also, it is a best estimate of the value of economic benefit. Here also discounting cannot be done. Again, this needs to be reviewed. If there is any inflow which is not arising, then we will reverse this. This is reimbursement. Reimbursement of what? Of provision. Reimbursement shall be recognized when it is reasonably certain that it will be received if the person settles the obligation. So this is a very minor concept here, so I would not dwell more upon this. However, at no point in time the reimbursement shall exceed the amount of provision. And where a person is not liable for payment of costs in case third party fails to pay, then no provision is required to be made. So criteria for recognition of provision under ICDS 10 is reasonably certain. If you are reasonably certain that this is going to happen, only in that case that ICDS 10 allows you to create a provision or contingent asset or contingent liability or a reimbursement. However, for AS and Ind AS, it is virtually certain. So let's take an example of case for liquidated damages in a trading transaction. So when will you say that this provision will be allowed to be recognized? If there is any adjudicating order of any of the authorities in the past that this has to be allowed and it's not challenged further. Or if there is any opinion from the expert, like a technical evaluation in case of a liquidated damages, there is some engineer certificate basis which the working has been arrived at. At those cases, we can see that, okay, it is reasonably certain because a lot of times there are provisions which are created if it does not have a technical backing. Say, for example, a provision for inventory or for that matter, some provision for saleable and non-saleable sales return. If it does not have any technical backing or any basis of arriving at this, then one cannot claim this as an allowable deduction. It needs to be disallowed or made as an adjustment in under this ICDS 10. And this is ideally a deviation from right to receive principle, where right to receive principle is not there, still you will be allowed to claim as a deduction. This is briefly disclosures which are required for ICDS 10 purposes. I would want to take a practical example here, considering we still have 5 more minutes. So if there is a MTM gain or loss on a currency swap contract, if there is realized exchange gain or loss, and this is on account of capital account because there is an imported asset involved, there is unrealized exchange gain or loss on account of an imported asset. There is realized exchange gain or loss on account of monetary items in case of an indigenous asset, and there is this unrealized gain or loss in case of an indigenous asset. And the last thing which I have taken is forward exchange contracts. What will be the scenario and how will we give effect, under which ICDS, etc. So quickly, I will just brief touch upon MTM gain or loss on currency swap contract. We discussed under ICDS 1. that because it does not have, there is absence of prudence concept, any notional or expected gain or loss will not be allowed. So therefore, ICDS 1, if there is a gain, that needs to be reduced. If there is a loss, that has to be added back. This cannot be claimed. On capital account, if there is any imported asset, so imported asset, and if there is any loan for the purpose of imported asset, this classic scenario will get covered under section 43A. So if there is any realized exchange gain or loss, the same will be governed by 43A, and all of this will get capitalized. So this is not ICDS, but section 43A. So first one was ICDS, second one is 43A. If there is any unrealized, then that will not be covered under 43A. But considering the fact that realized we were capitalizing it, whatever is unrealized has to be allowed to me as an expense or as a income. Considering realized we had capitalized, whatever the gain is, we will have to reduce it, and whatever the loss is, we will have to add it back, because we've already got one impact of realization under 43A. So unrealized again cannot be taken benefit for. Taking indigenous assets. So indigenous assets is something. So I have taken a loan and I have bought these indigenous assets. So loan being a monetary item, so indigenous assets 43A will not be governed. ICDS 1 में भी नहीं आएगा. So where will you go? You will go under ICDS 6. There is some loan which is taken for indigenous assets. Indigenous assets, though being non-monetary, but however, loan is a monetary item. So considering that loan is a monetary item, whatever the gain or loss is, be it realized or be it unrealized, monetary item has to be allowed, and gain has to be considered as income, and loss has to be allowed as a deduction. So this two will be governed under ICDS 6, item number 4 and item number 5, because this is on account of monetary item. The last, which is 6, exchange difference on forward exchange contracts. This again will be governed by ICDS 6. However, iska claim milega, because this is categorically for forward exchange contracts. We have a thing that mark-to-market gain or loss or exchange difference will be allowed if it is not in relation with speculation, hedging, etc. So what I have covered under this example is not just ICDS 6, but 43A, ICDS 1 and ICDS 6 also. There are two limbs. One is foreign currency transaction and forward exchange contract. So this is a practical application of ICDS in this scenario. Also, what I would want to highlight here is that there could be some scenarios where a particular item is reported under ICDS 10, say for example, contingent liability. And there is also clause 21 of the tax audit report, which requires you to report any item of contingent nature. One would need to be mindful that if you put the amounts both the places, there could be intimation later which would ask you to add it twice. So one would need to be mindful of the fact that in the entire tax audit report, at one place we are making appropriate disclosure, and in the other place, in the notes to the tax audit report, one can carve it out saying that considering that this is already covered under the clause above, it is not reported in this clause. Similar thing would also happen in case of a tangible fixed asset and foreign exchange fluctuation. So if in case there is any foreign exchange fluctuation for tangible fixed asset, clause 21 would say that would you want to disallow anything on capital account? You will have to mention any foreign exchange gain or loss on capital assets under clause 21 of the tax audit report. Also, the same one would require to report it under ICDS 6, or for that matter ICDS 5 if you've capitalized it. So just make sure that whatever disclosures we are making are not repetitive, and we make appropriate disclosures or carve-outs at each of the clauses, that since this is covered here is where we are not reporting it here. So this could be a few practical takeaways when it comes to the reporting or disclosure standards. Yeah. Any questions? I can now take it up, I guess. If the subsidy is received in later year, how will be the valuation of tangible asset? So as we discussed that whenever there is a reasonable, so I'll just take you to the relevant slide. Here. So we had earlier mentioned in government grants that if when you feel that when there's a reasonable assurance that these conditions will be met and when the grant shall be received, even though it is not actually received, at that point in time, we will capitalize it. So to the question, I'll just stop share. To the question that if it is received in the later years, we are going to make this adjustment when it is reasonably certain or there is a reasonable assurance that we are going to get it in that same year, we will capitalize it or we will make those adjustments in the tangible fixed asset. If unfinished foreign transactions, say for import of goods settled after the end of financial year at higher price than the value at which it is booked in the earlier financial year, do we need to pass foreign exchange loss in the earlier year, knowing that the transaction was settled at a higher rate in the next financial year? So this one will have to see at the end of, so as we discussed that one will be your foreign currency reporting when the transaction happened. Then at the year end, whatever be the fluctuation rate is what conversion at the year end rate is what entry we will pass. And when actually it is booked in the next financial year is where there will again be a loss. So there will be two limbs when at the time of conversion at the last day of the previous year and at the time when the transaction is settled. Both of the losses will have to be given effect. Considering it is import of goods, it would be receivables in relation to import of goods, which will be a monetary item. So one will have to categorize it as a monetary or a non-monetary, and then if it is a monetary, the loss can be claimed as a deduction. You can just unmute and ask question if it is not answered. If the grant received is more than the WDV of the asset, do we have to recognize the balance as income? Generally, if it is for the purpose of acquisition of asset, grant generally is in line with the valuation of the asset. If it is more, then yes, we will have to show it as an income. But one needs to see if there are any cost which is to be incurred for the purpose of this asset. Then it has to be a deferred revenue over the period where we are incurring that cost to settle that obligation. So I hope this is answered. Why Income Tax Act cannot have same accounting treatment as accounting standards as per Companies Act? That is something which I will not be able to answer. Is it possible to share a compilation of landmark decisions which contradict the specific provisions of ICDS? So Hitesh, to answer this question, the technical guidance clear, like it has categorically in each ICDS discussed about each of these judicial pronouncements is the reason I had not included here. It would have become very bulky. But once you refer the technical guidance, I'm sure you will be able to get of a gist of all of these landmark decisions. Any other questions? I think there are Hi, Kruti.
Hello, ma'am. I think all the questions are answered, and we'll begin with vote of thanks then. Good evening, everyone. I'm CA Kruti Parekh on behalf of WIRC. I'm glad to be here to express my heartfelt gratitude to all the participants of the Zoom meeting today. Firstly, we would like to thank our chairman Arpit sir and treasurer Ketan sir and Shweta ma'am and all other committee members of WIRC to provide us this platform where we can continuously gain knowledge and improve our practice. We would especially like to thank speaker Deepa ma'am today for illuminating us on the topic of ICDS, its application and comparison with accounting standards, and its practical approach while preparing and auditing the financial statements. Deepa ma'am, your knowledge has been incredibly enriching, and we thank you for sparing the valuable time of yours and the knowledge with us. This session was very enlightening for all the participants today. Lastly, I'll appreciate all the participants which made this virtual gathering a success. Once again, thank you everyone. We look forward for more such virtual gatherings, Deepa ma'am, so that we can gain good knowledge from your end. Thank you everyone.
Thank you so much
If
for this opportunity, and thank you all the members to be here despite being a festival in here.
yeah, if anybody has questions, then surely Deepa ma'am can answer right away.
Sure.
Anyways, I think we should end the session.
Sure. Thank you, everyone.
Thank you. Thank you so much.
Thank you. Bye.
Bye. Have a great day.